Hey guys, welcome to another video. Thanks for joining me in this one. So in this video, I just wanted to share with you two ETFs you should consider adding to your portfolio. Of course, do your own financial diligence or due diligence before investing. But if you're new here, welcome. If you're a returning subscriber, thanks for joining again. Quick thing. As we know, the stock market has been taking a beating lately because of interest rates, the war, the uncertainty in the economy, and of course, we have a very high amount of debt on the US government right now. So the issue is that there's a lot of worry and fear that there's probably a potential for a recession in the next 1 year. Now, how can we somehow hedge against the potential decline that we could experience in our portfolio? One of the ways we can do that is to find dividend given companies or ETFs. In this case, with the two ETFs I'm talking about, the first one is SCHD and the second one is VIG. Please, if you find value in this video, please don't forget to drop a like, don't forget to subscribe, and of course, don't forget to just let me know your thoughts in the comment section as well. That will go a long way. The first one that I will touch on is SCHD. As we can see, it has an expense ratio of 0.06, which is quite cheap. This is one of the common dividends out there that people would always invest in, and honestly, I see why. It's really good. $70.46 is the current share price or the price of the ETF. In the past 1 year, it's returned about 10%. In the past 3 years, about 12%. In 5, about 9%, and in 10 is about 11%. Since inception is about 12%. That's great. Now, why is this actually interesting? I would want you to see this, all right? So we have the companies that are included in the portfolio, all right? It consists of Amgen, Broadcom, Merck, Chevron, Cisco, UPS, and PepsiCo. These are the top 10 anyway. Now, with this type of ETF, there are two things you benefit from. The first one is, of course, the dividends that you get from it. And the second one is price appreciation, which means if the price goes up, you could also gain value, at least you make money as well. And the other thing with ETFs is that you can easily sell them, like from the name exchange traded funds, they're easily sold on the stock market. So they actually perform just like a stock itself, but they are different from a single stock of a company, and they're also different from like index funds or mutual funds. So the next question is, how does it compare to VIG? And VIG is right here. It has an expense ratio of 0.06 as well. The interesting thing is, for the past 1 year, this has returned 17%, about 3 years, 8%, in 5 years, about 9%, in 10, it's 10%, and of course, since inception, about 8%. The good thing about this one is also it has different companies, okay? So it has Microsoft, Apple, Exxon, JP Morgan Chase, Procter & Gamble, MasterCard. The good thing about investing in these two is that you don't have overlapping companies. And that is great, which means if, let's say, one goes down today, the other one may be able to keep the portfolio in the green. I mean, considering the amount you invest in both of them. But the point is, if you have the same or similar companies in both, the problem is that if this goes down, then this will also go down. But because you have different companies in both of them, that is really minimizing your exposure to that market or your portfolio performing in the same way, or at least the ETFs performing in the same way. So that is a good thing. Now, I did a quick calculation here just to share that with you. So for the, make sure you guys can see that. Actually, let me take myself off the screen. All right. For the SCHD, assuming we make the distribution annually, this is usually quarterly, but let's make it annually. You have 100 shares, which isn't a lot. I mean, again, you don't have to buy everything at once. Let's assume that you slowly build your position to 100 shares, and annual contribution about $6,000 at a dividend tax rate of 15%. You have an annual dividend yield of 3.49, which is what the company has actually, or the ETF has returned, at least the yield in the past with the recent data. With this expected annual dividend amount increase at 2% and expected annual share price appreciation at 2%, if you invest in this for 10 years, this is what you would have. You have about $86,767 with about 29.4 total return. With for VIG, you will doing the same thing, but the share price on this is slightly different. But put in $6,000 in it with an annual dividend yield of 1.89, which is still, like I said, is still from the company, from the data that is being pulled by this dividend calculator. Making this 2% as well, making this one 2% and investing for 10 years, you would have about $92,960 with a total return of 22.97%. In my opinion, that is great. That is great. That is because, first of all, it's cheap to get into. Secondly, you can easily, you don't have to buy the $155 worth of ETF at once. You can use fractional shares of this to get into it. Whether it's $10, whether it's $15, whether it's $20, you can use that to build your position. And you are edging against that total decline of a stock that is not paying you anything, and you have the ability to get income from it. So for example, if you want that income to come to you physically, you can actually set it up in your account, depending on what account you use, whether Robinhood, whether Fidelity, whichever one, Vanguard. This dividend can actually come to you and can be a source of income in the future. And that's what a lot of retired people also still use. And they just use their dividend to cover their expenses and take care of themselves. This is an idea that I just wanted to share with you. I want you to know that I am actively working on this as well, because it makes sense to have some form of portfolio, just mitigating some of the risk that you could potentially have in your portfolio if you don't have any dividend giving companies or ETFs in it. It just makes it a bit better overall. And of course, don't always go with the highest yield of ETF, because, well, especially with a company, by the way, not just ETF, with a company, because that could also mean that they're not investing or reinvesting in their business. Wanted to share this with you guys. I hope you found value in it. I hope you will learn and be able to put this to use. Let's work on this as to make ourselves better, and hopefully we can all reap the rewards. I'd love to see my next video, so don't forget to subscribe, and thanks for watching.